Welcome to the Deep Dive. Today, we're tackling Southwest Airlines' latest numbers, specifically their Form 10Q for the quarter ending June 30, 2025.
Right.
Our goal is pretty straightforward.
Right.
Cut through all the dense financial language, pull out the really key insights. We want you to understand their financial health, their, well, pretty bold new strategies, and the challenges they're facing. Basically, get the main takeaways without needing to read hundreds of pages yourself.
And what's really compelling here, I think, is watching how this airline, with its very distinct identity, is trying to adapt. It's a dynamic market, lots of competition. We'll look at the why behind these big changes, not just the numbers.
Okay, let's kick things off with those headline figures, the main financial snapshot. So looking at their official GAAP results for Q2 2025, operating income was $225 million.
Which is quite a drop.
It is, yeah. Down significantly from $398 million in Q2 last year. Net income also fell from $367 million down to $213 million. And if you look at the first 6 months of 2025, GAAP net income decreased 53.3% compared to the first half of 2024. Pretty stark.
Yeah, and if we sort of connect that to the wider picture, they're attributing these gap declines mostly to, well, weaker travel demand overall, particularly in domestic leisure travel. Southwest themselves say they're more exposed to that segment than, say, the bigger network carriers. But here's a key point. If you look at their non-GAAP figures, taking out those special items, their non-GAAP net income for the first 6 months was actually pretty flat compared to last year.
Right.
So it highlights why you really need to look at both GAAP and non-GAAP to get the whole story. The underlying business wasn't quite as weak as the main headline suggests.
Exactly. So for you listening, trying to get a quick handle on this, it means, yes, profitability is down compared to last year based on official accounting. But like you said, a lot of that hit comes from specific, maybe one-off items. Their core flying operations held up a bit better than those JAP numbers alone might imply. So with that baseline set, let's peel back the layers a bit. What's driving these shifts in revenue and costs? Where's the money coming from and where's it going? On the revenue side, total operating revenues for Q2 2025 actually decreased by $110 million. That's about 1.5% year over year. Passenger revenues specifically dipped 1.3% in the quarter, though they were almost flat for the first half of the year. The company points to a load factor drop, basically how full the planes are, down 4.1 points year over year in Q2.
Which is quite a bit for load factor.
It is. But they offset some of that with a 2.3% increase in yield, how much they make per passenger mile. That's thanks to revenue management tweaks and cutting back a bit on capacity.
And what's fascinating here is seeing the direct impact of customer behavior, especially with new things they've rolled out. Like in Q2, their RISM revenue per available seat mile, a key industry metric. It took almost a half-point hit just from a temporary drop in people actually booking the new basic economy fare right after it launched on May 28th.
Interesting.
Yeah, it kind of raises that question. How fast can a big company like this really react when a new product has an unexpected side effect? They say they jumped on it quickly, tweaked the website booking flow, the marketing, and they saw conversion rates get back to where they expected. But it shows there are bumps in the road.
And speaking of revenue, one area that's always revealing is their air traffic liability account.
Right.
This is essentially money received for tickets not yet flown, loyalty points not yet redeemed. It's future travel they owe.
It's a big number.
Huge. As of June 30th, it was $8.296 billion. What's really notable here are the details around loyalty points and flight credits. They changed their deal with Chase for the co-branded credit card this year, shifting more of the benefits classification into passenger revenues. And this is key for you. The Traveler, they updated their flight credit policy on May 28th. New credits from those basic fares. They expire in just 6 months now. Other fares get a year. But here's the kicker. Any credits issued between late July 2022 and May 28th, 2025, those still don't expire.
That's a really important detail for people holding on to older credits.
Absolutely. You need to know which policy applies to your credit.
Okay, switching gears to the cost side. Operating expenses in Q2 were up just slightly, 0.9%. For the first half, they actually nudged down 0.1%. The big drivers pushing costs up in Q2 were, well, no surprise, salaries, wages, and benefits at 8.8%, and landing fees and airport rentals also jumped up 11.0%, mostly just higher rates being charged by airports.
Right, those external pressures.
Exactly. It really underscores that challenge of managing inflation in areas like labor and essential operating fees.
And this is but for their bottom line, there was a huge help on the cost side.
Yep.
Fuel and oil expense. That dropped significantly, down 17.1% in Q2 and 17.7% for the first half of the year.
Yeah, and this ties directly into their fuel hedging strategy, or maybe the end of it. They actually terminated all their remaining fuel hedges in Q2. These were contracts meant to lock in prices, originally running through 2027.
Wow, all of them.
All of them. That brought in about $40 million in cash, but it also meant they had to reclassify $36 million from AOCI accumulated other comprehensive income.
Which is like a holding area on the balance sheet for certain gains and losses not yet hitting the income statement.
Exactly. They moved that $36 million into fuel and oil expense in Q2. So it's a bit complex. They explain that their economic fuel costs now reflect the actual cash they paid or received from these hedges. But importantly, there's still about $209 million related to these closed hedges sitting in AOCI. That amount will gradually trickle into their fuel expense line over the next few years through 2027.
So a past decision still echoing in future results.
Precisely.
And another big cost move, the workforce reduction back in February 2025. They cut around 1,750 corporate jobs, about 15% of those roles. That led to a one-time charge of $62 million in Q1, mostly severance. But the expected savings are substantial, roughly $210 million this year, 2025, and then $300 million next year in 2026.
That's a clear, direct action on the cost front. And looking forward, it's obvious they're not just trimming costs, they're pushing these transformational initiatives, as they call them, aimed at giving customers more options, boosting financials, driving shareholder value. It feels like a major strategic pivot.
Okay, let's unpack some of those really big changes we saw roll out in Q2. Most talk about one, probably. For flights booked or changed after May 28th, they introduced bag fees on most tickets.
A huge shift for the bags fly free airline.
Monumental. Though it's important to note, top-tier loyalty members, Business Select folks, A-list members, and cardholders still get free bags. They also launched that new basic fare on the same date, replacing the old Wanna Getaway.
And it doesn't stop there. They announced plans for a whole new set of fare products coming soon. Choice Extra, Choice Preferred, and Choice Replacing Business Select Anytime and Wanna Getaway Plus. And these will come with assigned and premium seating options. Sales start July 29th this year for travel beginning late January 2026.
Assigned seating at Southwest.
I know. It really makes you wonder, how will these fundamental changes reshape the whole customer experience and their competitive position? It's moving away from what made them, well, them.
And for anyone looking to travel further afield, there's some really interesting news here too. They announced their first ever trans-Pacific partnership with China Airlines, expected to launch early 2026.
That's a big step.
It is. Plus, they expanded their Icelandair partnership, adding connections through Orlando, Pittsburgh, and Raleigh-Durham starting mid-July 2025. More links between Europe and the U.S. network, and new service planned for St. Thomas in the Virgin Islands, also starting early 2026. Feels like a clear move to broaden their network reach.
On the fleet side, though, things are a bit more complicated. They're still working with Boeing on that massive 737 MAX order, the Negative 7 and the Negative 8. It runs through 2031, nearly 700 planes on order or option as of June 30th.
But Boeing's delays continue.
Right. Manufacturing issues, delays getting the Negative 7 certified by the FAA. It forces Southwest to constantly juggle their plans. They now expect more 9s/8s this year, 47 instead of 38, but they're also retiring more planes, about 55 this year.
It just shows how dependent they are on Boeing delivering. It affects their growth, their capacity plans.
Absolutely. It's a major external factor they have to manage.
So what about their outlook? What are they forecasting? For Q3 2025, they project RASM unit revenue to be somewhere between down 2% and up 2%. So kind of flattish on roughly flat capacity. Fuel costs, they estimate, will be between $2.40 and $2.50 a gallon, which seems manageable. And for the full year 2025, they're guiding for EBIT earnings before interest and taxes, excluding those special items between $600 million and $800 million.
And here's where you see their confidence in the strategy changes. They expect those transformational initiatives, the bag fees, new fares, etc., to add about $1.8 billion to EBIT this year, 2025, and a whopping $4.3 billion in 2026.
That's a huge projected impact from this overhaul, if they can execute.
If they can execute, exactly. But beyond operations, there's also a pretty active legal docket they're dealing with. There's that ongoing class action about military leave. They reached a settlement in principle back in February, with a court deadline for preliminary approval coming up August 21st. And another class action, this one under California labor law for ground workers, alleged missed meal breaks, wage issues. Some claims got class certification in February, and a trial was set for August 11th.
Shows those ongoing labor complexities.
It does.
And for shareholders, this next part is really quite telling about recent history and governance. Multiple shareholder derivative lawsuits stemming from that massive operational meltdown back in December 2022. The core allegation is failure to invest properly in tech systems, lack of oversight. A special committee investigated and actually recommended dismissing the suits. A motion to dismiss was filed in June.
Yeah, this really brings up questions about corporate governance, oversight, especially when a company faces major disruption and then pivots strategy so dramatically. And speaking of strategy pivots, just recently, July 10th, a new shareholder derivative suit was filed. This one specifically challenges the decision to ditch the bags fly free policy.
Directly challenging that core change.
Directly. It alleges the decision goes against what the company itself used to say and claims it was done mainly to appease a major activist investor, Elliott Investment Management, not for the company's own good. It also challenges a recent bylaw change Southwest made back in May, setting a 3% minimum ownership threshold for shareholders to even bring these kinds of derivative suits. That change aligned with the new Texas state law.
Wow. So internal pressure, external activism, it's all playing out.
It really is. A fascinating look inside.
Okay, finally, let's touch on cash management and shareholder returns. How are they handling their finances day to day?
Well, in Q2, they paid back a lot of debt. $1.6 billion of convertible notes and nearly $1 billion from a payroll support program loan from the pandemic era, all using cash they had on hand.
That's significant deleveraging.
It is. They also boosted their revolving credit line in July from $1 billion up to $1.5 billion, just for extra flexibility. None of it is drawn down currently.
And on the shareholder return side, they've been very active buying back stock. Spent $750 million in Q1, another $1.5 billion in Q2, through accelerated repurchase programs. Bought back nearly 70 million shares in total.
And they're not stopping.
Nope. On July 23rd, the board approved a new $2.0 billion share repurchase authorization. Signals continued commitment to returning capital.
And lastly, that working capital deficit about $4.8 billion as of June 30th. It sounds worrying.
But they note, and it's true, this is pretty common for airlines. Right, because of that big air traffic liability, all the cash collected for future flights sits as a liability, depressing working capital on paper.
Exactly. And despite that deficit, their liquidity looks strong. They reported $3.8 billion in unrestricted cash and short-term investments. Plus, they have a huge base of aircraft and other assets they own outright, valued around $16.6 billion, that aren't pledged as collateral for debt. And they still have investment-grade credit ratings.
So plenty of financial cushion. Their capital spending for this year is projected between $2.5 and $3.0 billion. So wrapping this all up, it's clear Southwest is in a period of intense change. They're juggling current financial performance, which is weakened, with these really radical strategic shifts, new products, new fees, network expansion, and all while handling these ongoing legal issues and operational challenges like the Boeing delays. What's the biggest thing that stands out to you from digging into all this recent activity?
For me, it really crystallizes into one major question, something for you to think about. How will implementing these new fares, the bag fees, the assigned seating, combined with the legal fights and the pressure from investors, how will all of that fundamentally change Southwest's brand, their identity, their competitive edge, everything they've been known for decades? It feels like we're watching a really high-stakes corporate evolution unfold in real time,